Welcome everyone to the Predictive Playbook. This is the financial educational show where we share our experience with trading in the financial futures markets, Bitcoins, option strategies. My recommendation to the owner of the Washington football team to change his team name to the Iron Condors, which is a pretty complex option strategy, but that sounds a lot more footballish than just the football team. But welcome to the show, Steve. Our last time on this show, we were talking about the probability was quite high that we were going to get a corrective measure. We're heading into the month of October now, which seasonality has not been all that good. There are months that are worse, but we always remember October 19th in '87 as being the first crash, and it's generally been a profit-taking type of month. But now we are seeing follow through to the downside, both in Bitcoin as we expected, and also the S&P 500 and NASDAQ markets are starting to crack a little bit. So what are you seeing on your end?
Yeah, I think the biggest thing that's here to stay is interest rates are rising, which means obviously the value of the bonds and notes is dropping. And so most people look at interest rates. So we'll say interest rates, I think they probably bottom out the last couple months. We're going to probably never see those numbers again in the next 10, 20 years, in my opinion. I think we're going to look back, 2-3 years from now and be like, wow, they almost hit one. So I think that's here to stay. It's been a pretty strong move. It looks like the follow through is there. And that, of course, is affecting the indices. They're not totally correlated, but the NASDAQ definitely gets hurt when rates go up because NASDAQ is more longer-term speculative stocks, which don't have the earnings up front. And the NASDAQ has fallen harder than the S&P. What was interesting, too, last week was the Russell actually rose a couple days on Wednesday and Thursday when the S&P and NASDAQ were falling. The Russell's now rolled over as well the last couple days. And I think that's the final capitulation. So the question isn't which way it's going. It's just how far will it go? Is it another short-term correction? I think this one is a little bit more than one of those 3 or 5% 1 or 2 days that we've seen like 5 times this year. I heard also yesterday, this is only the 13th market in history, John, in which over 12-plus months it has not retraced to the 150-day moving average on the S&P. It's only happened 13 other times in history over 100-plus years. So that also shows how, I don't want to say overbought, just how, straight up it's been. And it's right about to touch that. It's a head and shoulders resistance line at the same. There's like 2 or 3, and I always talk about technicals when they line up at the same spots. We've got numerous of them lining up right now, basically right where we are today on Wednesday, September 29th. And final thought on the S&P is earlier this morning, it kind of shot up a little bit, and then it held steady, and it's basically almost like a doji candle here as we go into mid-afternoon. So like almost a triple bottom of support right here. And that on the cash market right now is the close the other day was about 43.50, 43.60, 43.52. So it's hit about 43.52, 43.53, 43.50. It can hold down below that. I think that's going to become the new ceiling, and we're going to see it go down a bit from there. So it looks like it's happening. We knew it was going to happen at some point. Whether it's fast or slow, we'll see. But definitely a good time if you haven't done so already. If you're a long-term investor with, stocks only, move a little bit to cash. Actually, not a bad time to move to bonds. Bonds haven't paid anything for years now, but they're going up a bit. So I would highly recommend, not a financial advisor, but my personal opinion is move out of stocks into bonds here in the short-term future, if you haven't already done so.
Yeah,
hopefully.
we are. That's a good point. We're not financial advisors. We're pro bettors and pro traders. I would
Swing
call
traders.
ourselves.
So we're definitely a lot shorter term, obviously, than investors. We're doing swing trades, which could be a couple weeks, couple months. But my swing trade over the next few months is still that the market's going to be down and rates will be up.
3 days ago, we did have a big drop. Well, actually, it was 5 days ago. As you can see on the chart, and we're short that in our account that we have here that we can show our results. And that trade is working out fantastic because that was originally short. We have about 4 points in profit, a little bit more. That's 4,000 per contract at this point. Every 32nd of a movement is the minimum price movement in 10-year notes, and that's $31.25. And it adds up. It really adds up. And then you get these momentum, and you just stay with the trend. And honestly, Steve, it's easier to trade the bear market because the bears run faster than the bulls. The collapses are always bigger, faster, scarier, and nobody really likes to see them. But when there's an opportunity to hedge yourself, and simple strategies like the Apple put strategy we did last show is working. So if you own Apple and you did that hedging, you actually might be making money even though Apple's going down. And that's the shows. But before I let you go, real quick, you sent this to me, and I think this is, if you can give this a 30-second summary for the viewers, I think this says a lot. This chart.
Yeah, I mean, a couple things. First of all, one of the reasons Bitcoin dropped again last week was a little bit of a crypto ban over in China, and some other stuff also is why the market dropped in general. They're having some problems. They're also having some fuel shortages this week. So China really, something we've got to mention, China's kind of moving the S&P right now as well. But there's other factors there. But keep in mind, people have made a lot of money with Bitcoin. They've made a lot of money day trading in the stock market since last summer when sports betting came to a halt. They have yet to lose. As I just mentioned, first time, only 13th time in history that it's gone over 12 months without retracing the 150-day moving average. So at some point, people have to start taking money out to cover their losses. So if they're losing in Bitcoin or they're losing the S&P, I think they're going to be somewhat correlated. We've seen Bitcoin go down a little bit. But long term, though, I do think there's still some upsides to Bitcoin. As this chart shows, when China bans, it doesn't hurt it at all. Now, take this with a grain of salt because Bitcoin has gone up dramatically over the last decade. So maybe, it doesn't matter what happens. It's just gone up. And if you look at the recent time, since this past May when it last happened, it's only gone up 15% since, but that's obviously a shorter time frame. But those other numbers are just monstrous. I mean, it just shows that maybe Bitcoin is just too big for anybody to stop. And that's always been the talk about, the big knock will be if the U.S. bans it or whatever. And I've never heard anybody explain how they could do that. The whole concept of Bitcoin is that the government can't control it. So if anything, when the government tries to do something like this, I think it almost is it scares people into Bitcoin more, if that makes any sense, because that's the whole concept of crypto is to get away from government overreach. And that's why it ran in the U.S., because the government was spending money like drunken sailors since the COVID pandemic. And that's another thing, too. We talk about it's like a tight rubber band, and when it snaps, or it's a roller coaster, when it goes, it's much harder. This 10-year note, I mean, we're going to look back, like I said, over the next 10, 20 years in history. That's going to be maybe an all-time low that we don't see again for decades, in my opinion. And we're going to say, boy, was that a rubber band that had been wound up falsely for 2 or 3 years with all this government spending, the Fed overreach. And the Fed has so few tools left after COVID that at some point they're not going to be able to control the animal anymore, and it's going to burst out of its cage. And I kind of just get the feeling, John, that's where we are with the note. And that's going to have bad repercussions for the stock market by default. And it, theoretically, I think will help Bitcoin. So I'm still short of my trend following account. But long term, I'm still bullish Bitcoin. But once again, I'm not a fundamental, subjective, not handicapper, trader. Forget what we're doing right here. No. But short term, I'm short right now Bitcoin. But I think long term, I think it'll be higher a year or two from now, where we are now in the low 40s. It might go down still a little bit. I think the stock market, will it be higher a year or two from now? I don't know. It's going to be shorter the next month, I think. I think rates will be higher. Interest rates will be higher in the next month and in the next year. So the stock market's a tricky one because you're not going to make money long-term shorting the stock market. There's an upside bias. And with all the inflation we have and with the dollar weakening, that is why it's gone up so much, because where else are you going to put your money? It really hasn't gone up 40, 50% in value because of inflation, but it has gone up. But yeah, I think short-term, long-term rates, interest rates will rise, prices will go down. And short-term, I don't know about Bitcoin. Long-term, I think it's up. Stock market, short-term, I think it's down where it is a year or two from now. I still wouldn't want to have my money tied up in a buy and hold. I'll tell you that much right now. The risk-reward, to sum up, once again, the risk-reward is awful. I've said it for months. Even though it keeps ticking up 5 or 6%, there's still a 50% downside risk. Or it's like picking up, here's another good one to leave you with. It's like picking up pennies on a train track, right? Or nickels on a train track. That's one we've never used. Or a nickel in front of a steamroller, I've heard as well. People have to think about that. Let that marinate a little bit, but that's what you're doing. You're trying to make 5 cents when you're risking life. You're trying to make 5% here in the stock market when you could lose 50. That's not a good risk-reward ratio.
Yeah, we used to put coins on the train track when the train was coming through just to flatten them out into little pieces of metal. That was fun. But I think macroeconomically, in my experience on Wall Street, 2 decades worth, before I got into the sports betting realm too, tells me that historically, the average mortgage rate is over the last, say, 50, 100 years is 7.5%, 8%.
Right.
And we've had this great time. But at the same time now, because of all this spending, and sometimes I think it's fiscal irresponsibility, or it wasn't managed right, whatever the case is, that has put us in a big deficit. Now, how you get out of a deficit? You get inflation, because then you're using inflation is a debtor's best friend, and right now inflation pressures would be actually a good thing for the government. It would be a horrible thing for the rest of us, but it would help reduce that deficit.
And John, quickly on that, and not to get political here, but like when politicians lie, I stop listening. And we've had a lot of that recently, whether it's the Afghanistan situation or anything. When someone's going to tell me something I know turns out not to be true, I know is not true, why would you listen to anything else that comes out of their mouth? And the reason I say that isn't to bash the politicians, because it's easy to do that. It's the Fed that worries me, because the Fed is really powerful. And I'll tell you what hasn't sat right with me. We've talked about this for about half a year, almost a year now. This transitory inflation is BS. I don't see it. And you brought up a great point there. One or two things have to happen. They either have to rein in the spending, which we know is never going to happen. In fact, just this past week, a couple days ago, Congress just gave the military above what they are asking for next year's budget. After this debacle in Afghanistan, I don't care what side you're on, I think we all agree it was a debacle, they're giving them more than they were even asking for. They gave them a free raise. So they're never going to rein in the spending. It's out of control. It's other people's money. It's our money. And you know what happens when you have other people's money? You don't spend it responsibly. That's the biggest problem with Congress and our government. So the only other thing could happen, and to not ruin us, is to allow inflation to run. And the Fed keeps saying it's transitory, and they're basing their policies on something that I don't think is true, and I think they know is not true. I think they have no credibility. So why do we trust them to say they can rein this in? Why do we trust them to think that they have more tools in their box?
I agree.
And the market is the great truth in the long run. Yep. And I'm licking my chops to be short bonds and notes for the next 10 years here. I think, like you said, historically speaking, it is nowhere near the mean or the medium of what we've seen. Just in 2000, I got a mortgage rate at 8, and then I got it at 4 in 2009, 5 in 2009. Now it's 2.5. And it can't go much lower. You can have -4 in yields, but you can't have negative mortgage rates last time I checked. I'd like that. I own more properties. So, I think it's a great way to sum it up, but just be very careful. We all know we don't trust politicians, but people trust the Fed, and I'm starting to think that might not be a great long-term strategy as well.
Yeah, they're behind. They're behind the 8 ball now because they
have political
pressures.
In my
opinion, they should have raised rates a long time ago.
And they do have political pressures as well. They want to get reappointed. Yep. All this other stuff came out this week about they've got some holdings and bonds and whatnot. There's always a conflict, and they're squeaky clean compared to these politician dirtbags, but they're not 100% squeaky clean. And they're still humans, and that's the one thing that's never changed in 100-some years. That's why markets always break out, like you said, faster to the downside. It's human emotion, greed, and fear. And we haven't seen much of that over the past year. It's all been greed to the upside. We're about to see a lot of the other stuff here in the next few months.
I'm afraid you're right on that, but we're here to teach people how to take advantage of it and profit from it. So things go up, things go down. But like you said, generally the trend is up. And then you would be foolish to try to short all the time. You just would be. But I think in this environment, we're in the right positions, and our account's doing real well. So we'll try to do another show maybe Thursday or Friday.
Sounds good.
When time permits, because we're in the middle of football season now, so it's all good. I can't imagine having much more fun other than having NBA and college basketball added to my daily work loads, right? We don't sleep too much this time of year.
It's a good thing. But yeah, let me know, and we'll keep an eye on this, and hope the viewers will chime in with some questions. We can answer them in the comments as well.
Very good. Thanks for your time, Steve. And on behalf of Steve, myself, and the Predictive Playbook Financial Show, may all the winning trades be yours.